Well, welcome to the second component of Introduction to Accounting. We're going to be working through a comprehensive problem now. I hope you have all of the materials ready to start. All of the links have been provided, and hopefully you'll have printed off the material so that we can all work together today. So let's have a look at our comprehensive problem and all of the materials that you should have with you in order to start. And we're going to be doing two components of the required, two tasks in the required for this portion of the webcast, your second portion. So the story is we have Miss Lee and her family. They moved to Toronto, Canada in the spring of 2009. Miss Lee met three like-minded friends in her English program, and they were very interested in opening a spa business together. On October 1st, 2009, Miss Lee and her three friends incorporated a business called Lakeview Spa. We'll just call it Lakeview. Each of the four owners put in $15,000 into the business, and they each received 1,500 shares, which represented their ownership of the business. Lakeview Spa provides three types of services: hairdressing, body care, and fitness classes. And Ms. Lee has been appointed as the general manager of the business. So let's look at the tasks that are involved in solving this problem. What's required? We're going to be required to record journal entries in our key accounts for October, that's when the business was started, and to prepare a trial balance on October 31st, 2009 worksheet. So you're going to be preparing your key accounts and your trial balance for the first month of operations. Step 2, or requirement 2, prepare an income statement for October. Assume Lakeview pays income tax at a rate of 20%. So we'll be carrying over our information, our summarized information from our key account to our trial balance, and with our trial balance, we're going to prepare our income statement. In task 3, requirement 3, we're going to record journal entries, including adjusting entries in our key accounts for November and December, and we'll assume that Lakeview pays income taxes at a rate of 20%. Also assume that a 2% dividend will be declared on December 31st. A dividend is a distribution of earnings after they've all been recognized to the shareholders. So it's a distribution of earnings that have been retained in the company and distributed to the shareholders. In this case, it's a 2% dividend. With task 4, or requirement 4, we're going to be preparing an adjusted trial balance on December 31st, 2009 by using our worksheet. So now we're past October. We're going to incorporate November and December and prepare this adjusted trial balance for the end of the year. With that adjusted trial balance, we'll be preparing our financial statements, and in particular our income statement for the first 3 months of operation. We'll be also preparing a balance sheet as of December 31st, 2009. And in addition, one thing we haven't looked at is something called the Statement of Retained Earnings, and that will cover the first 3 months of operation. And that shows what's left in the company and is attributed to the shareholders, what they own. And for task 6, requirement 6, we're going to be preparing our closing entries in the general journal and a post-closing trial balance in the worksheet. So let's look at some of the materials that you've been provided with. This is Lakeview's chart of accounts. These are all of the accounts that we'll need in order to do all of our postings. Cash, accounts receivable, prepaid insurance, prepaid rent. We've got computer equipment with the accumulated amortization contra account, furniture and fixtures, along with the accompanying contra account, accumulated amortization, furniture and fixtures. We've got fitness equipment, along with the contra account, accumulated amortization, fitness equipment. All of those accounts that I just read off, they're highlighted in green, and those are asset accounts. So we're selected green for our asset accounts. The accounts that you see in red are 2000 accounts, accounts payable, salary payable, interest payable, unearned revenue, and long-term note payable. Those are all the things we owe in red. In purple, we selected purple for our shareholders' equity section. We have our share capital. Remember, they spent $15,000 each buying shares. It has to be posted somewhere. We've got retained earnings and dividends. All of those will be in purple. We also have our revenue accounts, and our revenue accounts we've highlighted in blue. We've got hair service, body care, and fitness. In taupe, or beige, we've got advertising expense, interest, insurance, rent, salary, utilities expense, as well as our amortization expense accounts, which have been broken out according to the asset category. So there's 5 different sets of accounts: assets, liabilities, shareholders' equity, revenue, and expense accounts. Generally, in its simplest form, we use account numbers. 1,000 accounts are usually used for assets, 2,000 accounts are used for liabilities, 3,000 series are used for owner's equity and retained earnings, and 4,000 accounts are used for revenue, 5,000 accounts are used for advertising. Many companies use different numbers. It really doesn't matter as long as you have some kind of system involved. With a much more complicated chart of accounts, you would definitely have much higher numbers. But things are quite simple in this problem right now. They'll get a little bit more complicated as we work through. So we're also going to be posting to our T accounts, and I've highlighted the T accounts again using our color coding. All of our asset T accounts are color coded in green. All of our liability accounts are highlighted in red, and all of our equity, shareholders' equity accounts, are highlighted in purple. We also have our revenue accounts highlighted in blue, and in beige we've highlighted our expense accounts. So those are all the 5 different classes of accounts, all in different color coding. Now we also, as I said, have our trial balances to work with. Again, color-coded for assets, payables, equity, revenues, and expenses. And this is 1/2 of our trial balance. The top half we'll have a peek at the bottom half in a moment. So you can see that the account numbers are listed, account title. We have our debits and credits under our first trial balance, which is called our unadjusted trial balance. That will be for October. We have our adjusted trial balance for December with our debits and credits. And once we've closed out our period, we have post-closing trial balance to look at. So there's actually 3 sets of columns, 2 per set for each set trial balance. So that's our top half. We also have the bottom half with our share capital and retained earnings, revenues, and in beige and taupe we have our expense accounts. Also ready for you to use some sheets that you've printed out, hopefully, to prepare your financial statements. So we can put our title at the top, our account categories along the left-hand side, and we can use the 2 columns to record the amounts that we're carrying over our trial balance. And for the purposes of journalizing the entries, which we'll also be doing, you have your general journal, which is provided space for date, account title, and your debit and credit entries. And when you have several pages of general journal entries, you need to make sure that the page numbering is provided so that you can find them. So that's all of the material that you need to work with, but we also have the questions. So starting again, we have Miss Lee. She started up a business with 3 friends, and they have put $15,000 each into the business, and we're going to start looking at all of the transactions that have been provided for us in order to do the analyzing and reporting of transactions. So let's start. So under the requirement 1, we were asked to record journal entries in our T accounts for October and to prepare a trial balance for October 31st in our worksheet. So we're told that the following business transactions occurred during the first 3 months of operations, and we're going to start with, in this first part, looking at the transactions that happened in October. So each of 4 owners put $15,000 into the business and received 1,500 shares each. So we're also told, highlighted in blue, is we opened a bank account for the business and deposited all the money into the account. So now we can record what's going on. We can record that $60,000 cash has been received and deposited into the bank. So asset category, we deposited $60,000 into the bank. But we've also issued 1,500 shares each to the 4 owners, who each paid $15,000, and we're going to record in our equity account share capital a credit of $60,000. So that's the first task started. Also on October 1st, we're told that Leslie rented a location in a waterfront mall for $1,500 a month, and she paid 3 months rent, 3 months worth of rent, as well as the last month rent deposit. So once again, we've got to post to our cash account. She has paid 4 months rent. The first 3 months have been paid, as well as the last, so 3 plus 1 is 4 months, times $1,500. So she's paid out $6,000 in cash. To reduce our cash account balance, we will make a posting to the right-hand side for $6,000. The offsetting entries will be entries to prepaid rent and to rent expense. So we can attribute October rent expense directly to the expense account, where we can recognize October's rent and post $1,500 to rent expense. We also have to realize that there's still 3 months rent that haven't been paid. The last month, as well as November and December rent. 3 times $1,500 is $4,500, and this is an asset account, as you can see in green, and we will do a debit entry to prepaid rent for $4,500, and we count entries balance $45, $15, and both sum up to $6,000. On October 2nd, we went shopping for the business and purchased a computer system costing $2,400, and she paid in full. So this transaction actually affects 2 asset accounts. So you see 2 green accounts in front of you. The computer equipment account has a debit posting of $2,400, so we're increasing the balance of our computer equipment account, and at the same time we're going to be decreasing the cash account by $2,400 because we're told that she paid in full. Also on October 2nd, Miss Lee purchased some furniture and fixtures for hairdressing costing $4,500, and she took advantage this time of a promotion. You don't need to pay for 6 months. So once again, we have an asset account that's being affected. We purchased furniture and equipment worth $4,500, so we will debit furniture and equipment account for $4,500, and we also have to recognize the liability. The $4,500, remember we're going to pay that in 6 months, but it remains unpaid for a while now. We have to credit accounts payable and bring that account balance up by $4,500. And that account's been highlighted in red to show that it is a liability account. Now item 3 on October 2nd, once again, Miss Lee purchased some fitness equipment for $8,600, and she paid $3,600 cash and would pay the rest in a month. So what do we need to do with that? Well, she's paid $3,600, so we have to reduce our cash account and credit that account by $3,600. We also have to recognize that we've increased our fitness equipment account, another asset account, by $8,600, so we'll debit fitness equipment by $8,600. 86 minus $3,600 leaves a liability to be satisfied in the future of $5,000. There's still $5,000 owing on this equipment, so we'll credit account payable for $5,000. 86 minus 5 is 36, everything balances. So what else are we told for October 2nd? Ms. Lee estimated the computer would last 3 years with no residual value. Hairdressing furniture and fixtures would last 5 years with a $300 residual value, and the fitness equipment would last 7 years with a $200 of residual value. And what this means is that she's estimating, it's not a certainty, that in 3 years the computer equipment will be used up and worth nothing. So we need to depreciate, we need to amortize that over 3 years. And we spent $2,400 on computer equipment. The hairdressing furniture and fixtures are expected to last 5 years, and at the end of 5 years, Ms. Lee is expecting that the equipment will be worth $300. So what we need to do in this case is write down $4,500 over 5 years down to $300 and recognize the using up of that equipment over the 5 years. And finally, the fitness equipment is estimated to last 7 years and have a $200 residual value. So Ms. Lee paid $8,600 or bought $8,600 worth of fitness equipment, and if we subtract out the $200 of residual value, that means over 7 years we have to recognize the using up of the fitness equipment of $8,400 and leave $200 left in the account, which is her estimate for what its worth should be at the end of the 7 years. All of these transactions were complete at the end of December. Needs to be recorded at the end of December, record the using up over that period of this equipment. So right now for October, we won't do it. We'll wait until later. What's the next task on our outline here? For October 22nd, we're told Lakeview received a utility bill of $400 and an advertising bill of $750, both which were due on November 7th. So utility bill and advertising bill, these are both expenses that have been incurred. So we're going to record the utilities expense of $400 by debiting utilities expense $400. We'll also recognize the advertising expense of $750 and we'll debit advertising expense. These are both expense accounts, natural balance, debit side, which is a left-handed posting. At the same time, we're not told that she's paid today. These invoices are only due on November 7th, so we have to record the liability of both the utilities and the advertising expense. We're going to increase our accounts payable, our liability account, by $1,150. So a right-handed posting, a credit posting to accounts payable to bring up that account balance. Our next item is a transaction that took place on October 28th now. Ms. Lee purchased a 1-year insurance policy for $2,400 and the coverage starts on November 1st. So she's received a bill. A 1-year insurance policy, when it's received that date, it will be posted to prepaid insurance because we'll recognize the using up of the insurance over the full year, and that year period will be November 1st this year until October 31st next year. So we will debit prepaid insurance and recognize the asset by debiting the account $2,400. She's paid for it because that she's purchased it. So we will reduce our cash account by crediting the cash account by $2,400. And you can see that both of these assets are accounts, and one is being increased and the other one is being decreased. On October 30th now, Ms. Lee recorded the service provided for haircut for the month of October of $2,600 cash. So she's received all of the money in full for the haircut services provided for the month. She also recorded the service provided by estheticians for facial, massage, and manicure for the month, and she had received $3,200 cash. So there's no accounts receivable. All of the revenues have been paid in full. So we can increase our bank account now by $2,600 plus $3,200, a net of $5,800. So we'll debit cash and recognize that cash that's come in over the month of October, $5,800 debit to cash, and it's an asset account. both the haircut services and the body care services are revenue accounts. Revenue accounts, if you remember, we say have a natural credit balance and natural right-hand balance. So we'll make a posting to Revenue Hair Service for $2,600 and a posting to Body Care of $3,200. And recognize the revenue earned and funds received for the month of October. Some expenses to generate those revenues. She had to pay $1,800 to the estheticians and the hairdressers for all that work they did in the month of October. So in order to record the payment for the salaries, we will post a credit of $1,800 to cash, reducing that asset account by the $1,800. We'll also post a debit entry to our salary expense, increasing that account balance by $1,800. Now, in order to prepare our trial balance, which will be used to prepare our October statement, we need to go back to our T accounts, all of the accounts that we've been working with, and we need to sum up the balance in order to have a balance ready to carry over to our trial balance. So we need to look at all of the accounts that you're postings to, and we've got the cash account to start with, and there's been several entries made to cash. If we sum up all of the entries that have been made on the debit side or the left-hand side, it totals $65,800. We now sum up all of the entries we've made on the right-hand side, and that totals $16,200. The difference between these two figures gives us a net debit balance of $49,600, and that'll sit on the left-hand side. We also have in prepaid insurance a debit balance of $2,400, prepaid rent $4,500, computer equipment $2,400, furniture and fixtures $4,500, fitness equipment $8,600. Our accounts payable, once again, has had several entries made to it, all on the right-hand side, all credit entries. There have been no reductions to our accounts payable account. Summing up all of the entries made on the credit side, we have a final balance for the month of October of $10,650. Share capital remains at $60,000 invested by the four shareholders. Revenue, we just recorded for hair service, $2,600 and body care $3,200. We have 4 expense accounts that we've made postings to: advertising, rent, salary, and utilities. We've made $750 debit posting to advertising, a $1,500 debit posting to rent expense, salary $1,800, and our utility $400. So all of those figures that you've tallied up in your T account can now be carried over to your unadjusted trial balance. So we'll carry over from cash the net amount of $49,600, prepaid insurance $2,400, prepaid rent $4,500, computer equipment $2,400, furniture and fixtures $4,500, our fitness equipment $8,600. And you can see all of those amounts are debit entries. They were debit balances on our T account, so we'll bring them over to the left-hand side for all of those asset accounts, all of those accounts highlighted in green. We also had in accounts payable, our liability account, a final balance for the month of October of $10,650, and we'll record that on the right-hand side of our unadjusted trial balance. For our share capital, we had $60,000. That remained unchanged. Blue accounts are revenue accounts, and we have 2 amounts to carry over for hair service and body care. Again, on the credit side, $2,600 and our $3,200. Our advertising and all of those other expenses that we have highlighted in taupe or beige. Advertising, we have a debit of $750, rent $1,500, salary expense $1,800, and utilities of $400. So we've carried over all of those amounts from our P account to our unadjusted trial balance, what we should do is always sum up all of the debits and sum up all of the credits and make sure that two amounts balance and are the same. They should equal each other. So you should have $76,450. And this doesn't ensure that you haven't made any errors. What it does ensure is that you balance. You still have inverted numbers and put debit instead of a credit and vice versa. But it does quite often point out problems that need to be rectified. So we have all of the amounts that we need in order to prepare our income statement. And that would meet requirement 2, prepare an income statement for October 2009. And as we mentioned earlier, Lakeview pays income taxes at a rate of 20%. So we need to consider that in the preparation of our October income statement. So your worksheet that you have for preparing your financial statements, for our income statement, we start with the title, Lakeview Spa Limited. The title of the statement is an income statement, and always mark the period that it covers. And this is the month of October 31st, month ended October 31st, 2009. So once again, we're trying to stay color coordinated so that you can stay organized. Our revenues are in blue, and we had 2 different sources for revenues, hair service and body care, $2,600 and $3,200. And that gives us total revenue of $5,800. And you notice we have 2 columns here to work with. We're not using debits and credits. We're just putting in the amounts in the first column and summarizing the total in the second column. For operating expenses, we have several accounts that we use this period, but we have these advertising, rent, salary, and utilities expenses, $750, $1,500, $1,800, and $400. And all of these amounts are being carried over from our unadjusted trial balance. Summing up all of our operating expenses, we have a total of $4,450. And the difference between our total revenues of $5,800 and our total operating expenses of $4,450 gives us operating income of $1,350. We now must consider our income tax expense, and remember it was 20%. 20% of $1,350 is $270. So we'll subtract the $270 from our operating expenses to come up with net income of $1,080. You'll note on the bottom of our income statement, we're showing something called EPS. EPS is earnings per share. And EPS is an indicator for investors how much a company will earn for the shares that they own. So EPS, we have 6,000 shares that are outstanding. Remember at the beginning of our story, we said that 4 shareholders each purchased 1,500 shares each. So we have 6,000 shares. Net income for the month ended October 31st of $1,080, and if we divide $1,080 by 6,000 shares, we have earnings per share of 18 cents. Now, we've completed requirements 1 and 2. Before moving on to the next component of this presentation, you should review your work and make sure that you've got everything tidy, organized to start the next requirements 3 to 6. So get all your paperwork back in order, and maybe perhaps do a review of what we've looked at before starting requirements 3 to 6.